Hello there. Welcome back to Accounting Space. In this video, we want to look at a common test of March 2018, and we are going to look at a common test from the province of KwaZulu-Natal. So we are going to start on the first question that we have on that first question paper, that is on creditors reconciliation. So this is the question that we have. And our question reads: Sebos Sebo cell phone shop sells various makes of cell phones and cell phone accessories. From Sussman reflects a different amount owed by Sebo's cell phone shop than the amount that was calculated in their creditors ledger for January. We are going to reconcile the January 2018 statement received from Sussman with the creditors ledger for Sebo's cell phone shop. Write a minus sign to indicate an increase or decrease in the balance. So we can take note of how we are going to go about our presentation in our answer section. So you are also going to have the second part of our question, which is 1.2. So going to the information given, we are given the following balances are provided on 31 January 2018. So we are given balance for creditors ledger of Sebo cell phone shop, and then we also have a statement from Samsung. Then beneath that we have additional information whereby we have the following errors and omissions were noted. So obviously, before answering, you need to go through all the additional information given in the question, going down to our G. So basically, that's what we have. So on our answer section, we are going to start with our creditors reconciliation, whereby you've got a column for creditors ledger of same also for the shop, and then we've got statement received from Samsung, and we have got a column that we have there. We are having the opening balances being pre-entered in our answer book. So obviously, we are going to start with our error A and see does it affect our creditors ledger, or does it affect our statement received from Samsung? So very important. So what is important for you to take note is that remember we have got the creditors ledger. We have the creditors ledger. So this is the creditors ledger, and we know that this is our debit side, and this is our credit side, and also we are having our statement of account from the supplier. So this one becomes the statement. So we also have our debit and our credit side. So we just have to take note that what is entered on the credit side of the creditors ledger should appear on the debit side of the statement. Remember, these two documents should contain the same information. So we are saying when the final balance of the creditors ledger is different from the final balance that we have on the statement of account, there's now need for us to prepare a creditors reconciliation whereby we are reconciling the two balances so that they become the same. So basically, a creditors reconciliation is just trying to correct the errors and omissions that transpired during the period. So we are saying information in the creditors ledger is the same information that you see on the statement. So the two documents should have the same final balance. So when there's a difference, we prepare a creditors reconciliation. So what we are saying is what we see on the credit side of the creditors ledger should also appear on the debit side of the statement. So the same applies on what we see on the debit side of the creditors ledger. We see it on the credit side of the statement. So take note of that. So as we correct those errors, we take note of that. And on the creditors ledger, as we are being given a one column, as we see that we have got a one column is presented. So it means we are going to show our adjustments as positives and negatives. So you should take note that in the creditors ledger, if an entry is on the credit side, it's a plus. The debit entry is a minus. So the opposite is true when you go to the statement now. So when you go to the statement, we are saying when it's a debit entry, that's when it becomes a plus. When it's a credit entry, that's when it becomes a minus. So when we buy goods or credit from our supplier, we credit those goods in the creditors ledger, and then we debit. It's supposed to be debited on the statement. The opposite is true when there are returns. We are returning now the goods with the supplier. We debit on the creditors ledger, and then on the statement we credit. So we can take note from that point of view, then we can be able to correct our errors easily. So we go to the first error that we have, which is error A. We say Sesman rejected the discount of 2,500 rands claimed by Sable cell phone shop on 10 January 2018, as payment was received too late to qualify for the discount. So we are saying um, in the books of Sable, in the ledger, they adjusted for a discount of 2,500, which was rejected by the supplier. It means on the statement it's not even appearing, and it's not supposed to be there because it was rejected. But in our books as Sable's cell phone shop business, we had recorded as a discount. Remember, what we have is like we have our creditors ledger, So when you buy goods on the credit, we debit. Sorry, when you buy goods on the credit, we're supposed to credit them in the creditors ledger. So we can just indicate that on the credit side, whereby we are saying it should appear there. So when we are making a debit to clear the amount that we are owing. So basically, when there is a discount, it means we have reduced the payment amount. We have reduced the payment amount. So in this case, it means we assume that we're given a discount when there was no discount. So it means since we had subtracted 2,500 in the creditors ledger, indicating a discount on the payment, we are supposed to do the opposite now to add back that discount. So basically, it's going to be an addition in the column of the creditors ledger. So the statement is not going to be affected since it was not appearing on the statement and it was not supposed to be there because it was rejected. So we go to answer second column of the creditors ledger. So that's what we have on that part. Then we can as well try to move on to the second part whereby we are having our B. So B, for B, we are saying credit note 1141 for 4,200 rands received from sales. Sussman was incorrectly recorded as invoice 1141 in the Sable cell phone shop creditors ledger. So the first thing to identify is which of the two documents is being affected between the creditors ledger and statement. So in this case, we are saying that this credit note 1141 for 4,200 received from Sussman was incorrectly recorded as invoice 1141 in the Sable's Photoshop. So the first thing is for you to identify which one is being affected. You see that what is being affected here is the creditors ledger, as we are indicated that it was recorded as an invoice instead of being recorded as a credit note in the books of Sable software. So this is the creditors ledger that is being affected. So we see that this one is affecting our creditors ledger. So remember, the credit note from the supplier, it shows that there are returns which took place, and the returns reduce the amount that we are owing to the supplier. So it's supposed to be a subtraction, but instead of a subtraction, it was entered as an invoice. So basically, that ledger. So this 4,200 was supposed to be on the debit side, as to show that they are returns. So remember, when we buy, suppose 4,200. We created our 4,200. So by correcting, we are supposed to first remove this 4,200, which is not supposed to, and then we remove this when we enter this first 4,200. But so it means we are going to enter twice on the debit the creditors ledger. So in this case, we have entered twice on the negative side. So it's going to be if you add the two, you see that we are going to get 8,400. So it's going to be a total of minus 8,400 that we are going to adjust our answer section. So we go to our answer section. We are not saying we are using the creditors ledger, whereby we are going to use minus 8,400. So understand that's what we have on that part. Then from there, we can now be able to move on to the next part, which is now our C. So going to our C, you see that our C reads invoice 1810. Invoice 1810 was correctly recorded by Sebo cell phone shop as 35,000 35,490 rands, and not as 53,490 rands as recorded by Susman on their statement. So remember we said the first procedure is to identify which is being affected between the two documents. So we are seeing that the creditor's ledger is correct, as it's saying it was correctly recorded by Sebo's cell phone shop. So which the ledger is inside Sebo's cell phone shop. So this figure is the one which is correct, and this figure is wrong, which is on the statement. So we see that the document which needs correction is the creditor's statement. So creditor statement is the one which needs correction, which was recorded with a higher figure. So basically, yes, invoices come on the debit side. This is our statement. This is our statement. So basically, what we are saying is we've got a situation whereby we've got a higher figure on the debit side of the statement. So this is our credit. So we are saying we have got 53,490 on the debit side, but it's supposed to be 35,490. So we got a bigger figure. So we need to reduce it to the different 1,490. We subtract 35,490, and you're going to see that you're going to get a difference of 18,000. So we have 18,000 more on the debit side of the statement. So by removing it, we added 18,000 on the credit. The debit is a plus, when it's a credit, it's a minus. So basically, it's going to be a negative 18,000 on the creditor statement column. So let's take a note of that, and then we go to our other section, we indicate it as that. So we have got C, which is now negative 18,000. So we say negative 18,000. So having that, now we move on to the next one, which is going to be we're moving on to our D. Our D reads the goods are retained to Sussman by Sebo cell phone shop as per debit note 102 was incorrectly recorded as 9,500 rands instead of 5,900 rands as per credit note 11784 5,900. So we can just check first. Remember, the first procedure is to identify which of the two is being affected between creditor's ledger and statement of account. So you are going to see that we are told that this is goods returned to Sussman by Sebo cell phone shop as per debit notes 102 was incorrectly recorded as 9,500 instead of 5,900 as per the as per credit note 11784 5,900. So remember, we can also try to understand what is this one is a debit note, this one is a credit note. So a debit note is issued by the customer. Remember, the credit note the supplier. So if you understand from that point of view, when you say debit note, it means in the creditor's ledger of Sebo cell phone, it's supposed to be debited. Then on the statement of account of the supplier is when you say credit note, on the statement of account of the supplier is supposed to be credited. So we take note of that again. So what we are saying is we are saying that the credit note on the supplier is the one which is being said it's correct. Is the one which is correct. So the correction which needs to be done, it needs to be done in the creditors. Sorry, it's supposed to be done in the ledger. So you can just indicate in the ledger. That's where we need to correct of the ledger. We are having a debit note which was entered as 9,500 on the debit side instead of 5,800. So it means we entered the bigger figure. We entered a bigger figure. So to reduce this figure 9,500 to 5,000 to the correct figure of 5,800, we need to subtract the difference so that it goes down to 5,800. So that we are going to get an answer of 3,600. So we are supposed to correct it by entering 3,600 on the credit side so that it goes back to 5,900. So remember, in the ledger, we said credit is a plus, debit is a minus. So we've added on the correction is on the credit side. So it's going to be a plus in the ledger column. So we come here on T, we are saying plus 3,600. Then we can move on to the next part. So the next one is E, which says Sussman, if reflected invoice 1242 for 23,000 rands on 15 January 2018. This, however, led to another customer. Same as cell phone, shop, and not to a Sebos cell phone shop. So we see that we have an error, and that error is on the part of the creator's statement. We are seeing that it was entered on the statement, but it doesn't belong to Sebos. So it's appearing on this one's statement. So basically, we have to remove it from the statement of account. So we've got 23,900. So by removing it, obviously we subtract it. So it's going to be a negative 23,900, as simple as that. So we come here, we come here, go to the statements column, and then you say minus 23,900. So basically, that's what we have on that part. And then we go through our F. So our F, we are saying Sebos cell phone shop did not record the trade discount of 1,500 rands received from Sussman on 25 January 2018. So we have got 1,500. Remember, a discount, it's a discount. And you know that a discount reduces the amount. So basically, what is being reduced is the amount that Sebo is owing. So we are supposed to say negative 1,500 in the ledger, but there was no entry of such. So we are supposed to say negative 1,500. So basically, we go to here under the previous ledger, and we are saying negative 1,500. So basically, that's what we have. Then from there, we can now move on to G, which appears to be the last transaction that we have. We said invoice number 2056 dated 30 January 2018 for 26,250 rands was not recorded on the statement received from Samsung. So basically, it's an invoice, and an invoice is supposed to be a positive on the statement of account, but it was not recorded. So it's an omission that is there. So we need to record it, and we record it as a positive, as a plus. So plus 26,250 in the column of the statement. So come here, we say plus 26,250. So basically, we have adjustments that we have. So from there, we can now be able to calculate the final balances, whereby we can start with the creditors ledger, whereby we're saying 132,700 plus 2,500 minus 8,400 plus 3,600 minus 1,500 and obviously 8,900. And we do the same thing in the 2,550 minus 18,250. And the final answer again that you get is 128,900. So remember, we said the two balances will be the same after you've reconciled. So you have made them the same. So that's how we prepare our creditors reconciliation. So we go to the second part of our question. And we see that it reads, Sizwe is employed at Sebo cell phone shop. 20 February 2018, he accidentally dropped a brand new cell phone valued at 3,000 rands. This caused screen to crack. Sebo instructed Sizwe to return the phone to Sussman and to claim that the screen was already cracked when the phone's box was opened in the shop. Was this the ethical way for Sebo to react in this situation? Give a reason for your answer. So was it the ethical way? Is the first response. So basically, it's not the ethical way. It was not the ethical way. That's the first statement, because this cell phone cracked wireless on Sebo's cell phone shop. It's not true that it came like that. So basically, it becomes unethical. So it's not ethical. And then the reason is the reason that we have just highlighted, that the phone was not damaged when it was delivered. So it should not be sent back. Basically, just like that, we have given the response. So going to our answer section, we can just respond as such, whereby we say it's It was not ethical, is the first response. It was not so, we say the phone, this is now the reason, the phone was not damaged. So it should not be sent. So it should not be sent back. So this is the response that we have on 1.2. So basically, this is what we have on the first question in this first question paper, and we can try to as well try to proceed to the next question that we have. So on our question 2, we have got 41 marks, and that requires you to spend on average 25 minutes. And the question is on partnerships. So our question looks at the following information was extracted from the records of Tozo Traders, which is owned by T. Thomas and Z Zone on 28 February 2018. The financial year ends. The business maintains a profit markup of 60% on cost. Direct net profit after adjustments for the year ended 28 February 2018. And the question is, on the information given, we can just proceed to see the information given in the question. So this is the information that we have in the question that you also need to go through before you start to answer the question. So information is going to information I. So we can try as well to proceed. Then we have got K again, information J and K, which is also part of our question. On our other section, we're going to start on the calculation of the correct net profit after adjustment for the year ended 28 February 2018. So the first figure that we need is the figure of the net profit balance, which needs to be corrected. So if we refer back, you're going to see that we are told that the net profits are before adjustments. First point, the net profit before adjustments for the year ended 28 February 2018 is calculated to be 632,090. So this is the first figure that we have. So we have 632,090. Then from there, we see the adjustments, which how are they going to affect our profits, our balance, which needs to be adjusted. So if we go there, we start with additional information A. You're saying 2,000 rands was received from a debtor whose account was previously written off. This year has not been recorded. So we take note of that. So let's just try to analyze this statement whereby we are saying 2,000 rands was received from a debtor, which means it means this debtor was previously a bad debt. It was written off to become a bad debt or a credit loss. So when the debtor comes back and pay the amount that was previously written off, it becomes bad debts are recovered. It becomes bad debts recovered, and bad debts recovered is income. And when it's income, it increases the net we are supposed to add it to our net profit balance that we have, because it needs to increase the net profit balance. So we come here, we're going to say plus 2,000. So that's what we have. Then move on to the next part. On the next part, try to see if it's now B. And B reads trading stock on hand as per the physical stock take was calculated to be 38,250. The balance according to the trading stock account in the general ledger was 37,700. So the one that is in the creditors ledger represents the book value. Then the one that was after physical stock count is the physical stock count figure. Physical stock count. So we compare which one is greater between the two. So you see that you compare the two, you see that our physical stock count figure is greater. So when we have physical stock count figure being greater than the book value, we refer it to as a surplus on trading stock adjustment. Surplus on trading stock adjustment, whereby we are saying what was physically counted is more than what is appearing in the books. So when you have such a scenario, it becomes a a surplus. So we have got a surplus of how much now? We say 38,250 minus 37,700. Then we see what we get there. Let's just try to calculate that. Whereby we are saying 38,250, and then we subtract 37,700. Then the answer that you are supposed to get is 550. So here we get 550. So it means we have got a surplus of 550, which we need to add to our profits. So we come here, we say again plus 550. So we can then as well try to refer back. So moving on to the next part, whereby we now have C, which is saying consumable stores purchased for the year amounted to 4,760 and was included in the calculation of the net profit. Of this, 4,360 was used by the business. So what was used of consumable stores is the expense. So this was the figure that was supposed to be charged in the income statement as consumable stores in the form of our expense. But what was adjusted was 4,760. As it says, it was included in the calculation of net profit. So we know that if it's an expense, it reduces the figure for net profit. So the figure that we used to reduce the net profit figure was greater than the actual figure. So we needed to remove the excess that we reduced. By removing it, we added it back. So we have 4,760 to find and subtract 4,360. So we can as well try to calculate it from that point of view and see what we get. We say now 4,760, and then we subtract 4,360, and then we're going to get your. We are supposed to add back 400. So we go again for other section, and then we're going to say again plus 400. Then move on to the next part. Next part, which is going to be our T, the provision for bad debts needs to be increased by 540. The provision for bad debts needs to be increased by 540. So basically, if it's an increase, we know that it's an expense. When it's a decrease in terms of profit, a provision for bad debts adjustment, when it's a decrease, it's an income. So this one is an expense. Since they're saying increased, it means this one is an expense. And it's supposed to reduce by 540. So it's minus 540. So we come here, we adjust it as such, we say minus 540. Then we move on to the next part whereby we are now saying the telephone account for February, this 850 rands still needs to be paid. So this is very clear. We need to further subtract again 850 as an expense. Telephone is an expense. So this we are saying we're just supposed to say minus 850. So just compare there. You say minus 850. You go on to the next part. If insurance includes an annual premium of 5,400 paid for up to 31 July 2018, the figure was used to calculate the net profit. So it means let's start by identifying our financial period. We're starting, where it's ending. I will say that our financial period is ending 28 February 2018. 28 February 2018. So we are having a scenario whereby we are saying 28 February 2018. That's why it's ending. So it started the previous year, 1 March 2017. So this is our financial year. But we know that the annual premium is for 12 months. So it's for 12 months, which is up to 31 July 2018. Of which 31 July 2018 is out of our period. Our period is ending 28 February 2018. So it counts the number of months that are outside the current period. So we've got March, April, May, June, July, which is 1, 2, 3, 4, 5. So we've got 5 months that were included in the insurance figure of 5,400 that we subtracted as an expense, which is not supposed to be the expense for that period. Remember, we are supposed to comply with the matching principle, which says we should record what belongs to this current period and this period. What doesn't belong to this period, we don't adjust it. So this insurance for 5 months is supposed to be removed. So we calculate it's for how much? For 5 months. So it's now say 5 over 12 times 5,400. So we do that now. We see what we get there. Whereby say 5 divided by 12, and then we multiply by 5,400. So we are going to get it as 2,250. So here we've got 2,250. So this is the excess that we subtracted. So we need to add it back because we over subtracted or we overstated the figure for insurance. So we need to add it back 2,250. So we come here, we say plus 2,250. Move on to the next part. So on the next part, we are now on G, is saying the interest on loan must still be paid for the last 3 months of the financial year. 22,500 rands interest has been paid to BB Bank so far this year and was accounted for. So we have the interest for the last 3 months of the financial year. And it means the one that we have is for the period which does not include our 3 months. So we are saying we know that our year has got 12 months. So if you say 12 minus 3, get your 9 months. So it means this figure that we have for interest is for 9 months. So 3 months. Remember, interest is only supposed to be subtracted in the income statement. So to calculate, we just make a simple proportion whereby saying 9 months is equal to 22,500. Then what's a mark? So we make a simple proportionate calculation whereby we say what we don't have is 3 over what we have 9 times given figure 22,500. So we do that, we see what we get there. So we say 3 divided by 9 times 22,500. So we are going to get your answer 7,500. 7,500. So we are supposed to further subtract 7,500. So we come here, we further subtract our 7,500. So this is what we have on that part. So we try to move on to the next. So we go to the next part whereby we have H, we're saying the rent for March 2018 has already been received and is included in the amount of 79,800 rands recorded on the general ledger and used to calculate net profit. The tenant has been renting since 1 June 2017. The rent has increased by 600 rands per month from 1 January 2018. So we have got a bit of a complicated calculation that we need to go through. So remember, let's count the number of months that the rent is applicable according to the current period. So you are able to see that our year is ending. Let's just try to just refer back again. Our year is ending 28 February 2018. So that's when our year is ending, 28 February 2018. And we are since 1 June 2017. So we are saying the whole of June, July, August, September, February. So we count the number of months that we have there. And then we also have for March again, it's been received. So we also have March. So we're saying 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we have 10 months. So this 79,800 is for 10 months. And then, but we're told that the rent increased by 600 rands from 1 month before the increase and then after the increase. So before the increase is from 1 June 2017 to 1 January 2018. So the whole of June, July, August, September, October, November, December. Then 1, 4, 5, 6, 7. So we have 7 months before the increase. Then after the increase, also received. So we have got January, February, March. We have got 3 months. So we have got 3 months. So we can now be able to come up with our formula, and it increased by 600. So we just formulate our formula. So we let our rent just be R. Let rent monthly rent. So let's just say let's monthly rent be R. And then we formulate our equation whereby we are saying before it was a 7R. We can just try to come up with a calculation whereby we are saying before the increase it was 7R, and then we add after the increase where we have our 3 months. So we do that. The answer will be equal to 79,800. So we come here, we say equal to 79,800. Right. So from there, we can now be able to simplify our calculation, whereby it becomes 7R plus, we remove the brackets, and it becomes 3 times R, it becomes 3R. 3 times 600, it becomes 1,800, equal to 79,800. Then it becomes 7 plus 3R, it becomes 10R. And then here we're saying plus 1,800. So plus 1,800, we take it to the other side, it becomes negative 1,800. So we're saying 79,800 minus 1,800, it becomes 78,000. And then we divide by 10 both sides. We get it as R is equals to 7,800. So basically, this is what we have in terms of R. And we know that R is the rent before the increase. And the month that we are looking for is the month for March 2018, because March 2018 does not belong to this period. So we received in advance. So income received in advance. So we need to subtract that in advance for 1 month of March 2018. So, but for March, it had already increased by 600. So to get the rental for March, we are now saying for March rental, which was after the increase, we are going to say 7,800 plus the 600 increase. And then what we get, we can as well try to calculate that one. You're going to get your answer as 8,400. So this is the rental for March, which we need to subtract. So we're going to subtract 8,400. So we come here, we're going to say minus 8,400. So basically, that's what we got that part. We move on to see if we still have any other adjustment. We are now having interest on capital, which is not part of our calculation of profits, and then we proceed. We now have partner salaries, which is not part of that again. It's profit and loss sharing ratio, not part of that. So we have exhausted our adjustments, so we can calculate the correct net profits balance. So it's going to be equal to, so you make a calculation by adding and subtracting. Then the final answer that you're supposed to get is 620,000. So this is your final answer. So basically, this is what we've on 2.1. Then obviously, in terms of the next question, we can also try to refer back. On the second question is saying, complete the following accounts in the general ledger for the year ended 28th February 2018. First part is current account T. Thomas, and then second part is appropriation account. So we can start by current account of T. Thomas. So this current account is only for T. Thomas. So basically, you need to know what goes to the debit side of the current account and what goes to the credit side of the current account. So remember, the interest on capital should be on the credit side, and the salary should be on the credit side of the current account. And also, we check in terms of drawings, should appear on the debit side of the current account. And if there's we have interest on drawings in the question, it should be also be on the debit side of the current account. So this is what we have, particularly in terms of preparation of the current account. So we are just going to go about that layout. So we go to our answer section again, and this is our current account. And we have got the opening balance being pre-entered, which means all the entries that are going to follow are going to be at the end of the period, which is going to be 2018. So here we are going to say 2018, February 28. So this is our all the other entries that are going to follow, which is also going to apply on the credit side, 2018, February 28, which is at the end of the period. So we check for those items that we have identified, which should be on the debit and which should be on the credit. So we go there. We see that on item I, say interest on capital is to be paid at 8% per annum. Our capital increased on 1 September 2017. So we check the capital balances. We can try to refer back to check our capital balances. We'll see that our capital balances, we only want for Thomas, since we are preparing current account for Thomas only. So at the beginning, it was 200,000. That is 20 February 2017, 200,000. Then at the end, it was 206. So it means the capital balance increased during the period by 60,000. So we need to count the number of months that we have before the increase and after the increase of capital balance. So we can as well try to count them. It was increased on 1 September 2017. So remember the year is ending 20 February. So we're saying March, April, May, June, July, August. Then 1 September, it increased. So we're saying 1, 2, 3, 4, 5, 6. So we've got 6 months before the increase of capital balance. Then also 6, remember we've got 12 months in a year. So 6 months and after. So we make our calculations within that context. So calculations of before the increase. We are going to say our 8% is 8 over 100. We multiply by the capital balance before the increase, which is 200,000. So multiply by 200,000. And then the number of months is 6 over 12. That is before. Then after, it was not 260. So say 8 to 260,000. And then the number of months again 6 over 12. Then we calculate to get the interest. So we can as well try to see what we get from there. So we are saying 8%, which is 8 over 100, becomes 0.08 as a decimal. And then we multiply by 200,000. And then obviously we outplay again by 6 over 12. And then we get our 8,000. We do the calculation now, the second calculation of after, say 8% times 260,000. And then you are going to get your answer is 10,400. So 18,400 is the interest on capital for Thomas. So we go there and put our 18,400 is interest on capital on the credit side. Interest on capital with 18,400. And then we move on to the next part whereby we are given. We can move on to the next. We have got partner salaries for the year, and we want for Thomas, which is 272,000 rands per annum. So we are supposed to also enter it on the credit side, whereby we say salary, and we have 272,000. And then we'll check again if we remember we each of drawings and interest of drawings, but according to the question, we do not have interest of drawings. So we can check the drawings balance. For Thomas, it's 314,000. So we are just going to debit side and we are saying drawings. So for drawings, we put the whole amount, 314,000. So if the question was interest of drawings, we're supposed also to put interest of drawings. But according to the question, we do not have. So from there, we can now be able to see. But remember, we also have the appropriation amount, which is coming from the share of profits. And this amount, we get it in the appropriation account. So if we check, according to our question, we have appropriation account on the second part. So we are supposed to prepare the appropriation first so that we get the appropriation amount. and we put it in the current account. So we can now be able to balance it. So now we can just leave it, and then we come back and go to 2.2.2, whereby we're saying this now is going to be our appropriation. So on our appropriation, we are going to start by entering our profit and loss figure, which is the profit for the year which we calculated. Remember, we got it as 620,000. So it's supposed to come here. And we know that this is at the end of the period, which is 2018, February 2018. So this is what we have. And then we are saying we are going to enter our profit and loss. Figure out this 620,000. And then we are supposed to appropriate now this 620,000 in terms of the interest on capital, the salaries, you see. So what we are going to do is that as we have already prepared the current account, you can now be able to see that what we see on the credit side of the current account, we're going to put them all on the debit side of the appropriation. Take note of that. Take note of that. So we have interest on capital, but interest on capital we only calculated for Thomas. So in the appropriation, you're now putting the total amounts for all the partners. So we can start with interest on capital. So our date again is 2018, February 2018. So we can start with interest. We can start with interest on capital, whereby we are saying we have already calculated the capital, the interest on capital for Thomas, and what we got was 18,400. And then we now calculate for the other partner. We've got 8% interest on capital, and we do not have any change. If you check there, the capital for Zondi did not change. So we are just going to use 200,000. So 8%, 8 over 100 times 200,000. And the figure that you are going to get there, let's just try to see what we get. You're going to get it as 16,000. So you have 16,000 as interest on capital of Zondi. So to get the total interest on capital, you're now saying 16,000 for Zondi, plus the one that we have for Thomas, which is we calculated it and we got we can refer back. We got 18,400. So we get our 18,400 here, and we'll see what we get there. You're going to get your 34,400. So that's the figure that you're going to put as your interest on capital. So we come here, we say interest on capital 34,000. 34,400. And then we have got information about salary, whereby you got 272,000 for T. Thomas. So salary comes on the debit again. So we're going to say salary, Thomas, 272,000. And then we fed back, you see that we also have salary for only 20,000 per month times 12 months per year. You get 240,000. So we come here now, we say Zondi, and we're saying 240,000. So basically that's what we have. And then from there, we have finished our operations. So we can now be able to compare the two balances, whereby you say 620,000 is the greater total. It's supposed to come in between the double lines, both sides. And then we now have the share of profits. But if you come here, you'll see that we are told that they are going to share equal. And we have two partners. So it means the difference that we get, we divide by 2. So we come here, we now say 620,000 minus 240,000 minus 272,000 minus 34,400. And with that, we can see what we get there. We get 73,600. So this 73,600 is one that we are going to share equally between Thomas and Zon. So we are just going to say, and we transfer that amount to current account. So we're going to say current account, whereby we have Thomas and Zon. So we say 73,600 divided by 2. So we divide by 2 and we get 36,800. So basically we are saying between the partners, each one will get 36,800. So we have finished in terms of our appropriations of share of profit. So since this one we are debiting the appropriation, so it means it's supposed to go to the credit side of the current account. Remember, we're concerned about Thomas, since we've got the current account of Thomas that we need to complete. So it means if it's a loss, it will be on the credit side of the appropriation. Then if the current, it will be on the debit side. So we take note of that. So we're just going to take 36,600 for Thomas, and then we come here, and what we are going to. So we go to the credit side, we say appropriation. 36,800. Then we cannot be able to balance our account. We get the total of debit and credit, and see that the total that is greater is the credit side with a total of 327,200. So we put 327,200. And then we subtract what we have on the credit to get the balancing figure, which is now going to be 7,000, and it's now balance CD, which is going to come here as our balance BD. And we know date is the first day of the next period. Remember, we are still in 2018, but it's going to now be, our year is ending 28 February, so the next financial period will start March 1. So that will be your PD. Can you see this date is the same as of 2018, February 2018. So that's what we. So we have finished on that part, which is current and appropriation. So we still have another question that we have is saying, are both partners satisfied about their actions, comment on shareholders, transactions in the business during the financial year? So you are going to see that they are going to be satisfied. So obviously you can just raise one point, they're going to be satisfied, then you support your answer. So in this case, we can say yes is your response. Yes, they're going to be satisfied. Then why are we saying so? It's because we are seeing that in terms of, let's just see, the profits are being shared equally between partners. So that can be the reason. Profits are being shared equally between the partners. So if you decide to say no, maybe you can give a reason of saying, we see that Thomas has contributed a further an additional 60,000 rands. And now he has got, if you check in terms of the capital balances, we can just try to see. Thomas is now a more capital balance. So it means Thomas was supposed to be rewarded by earning higher profits. That is a no answer that you can use and justify in that respect. So that is what we have. Obviously, our next question is now going to be our question 3. So our question 3 is 23 marks, and requires you to spend 14 minutes on that question. So it's on tangible assets. So our question is: the following information was extracted from the accounting records of Umla as a source. The business financial year ends on 31 May each year. Then on the required part, first part, calculate the missing amounts. Details are labeled A to G. Next, in the given general ledger, in the given so part marks can be awarded. So 12 marks we have on that part. And then we now go to the information given. According to the question, we're given the general ledger of Umla stores balance sheet section equipment. That's where we've got the missing figures. And that's we have also a continuation of the missing figures. Then we have additional information that we have A and B that are going to help us answer the question. So we start with our A, whereby our A, we've got 120,000, and we have CJ. Obviously, CJ is creditor's journal. So basically, this equipment that has been bought or purchased on credit, because its information is coming from the creditor's journal where credit transactions are recorded. So this is purchased on credit, and obviously A now represents the creditor's control. So we have creditor's control being our A. So A we can as well try to. So we are saying A, we have creditors control. You go to B. B is a balance sheet. So very simple it is. We see that balance sheet, obviously, we are seeing that we don't have anything on the credit. So it means the same balance sheet, the same greater total in between the double lines is the same figure that is not coming. Remember, what is supposed to be on the credit, the total should be equal to what we have on debit. So since we don't have anything on the credit side, so it means 360,000 automatically becomes our B. So we have 360,000 being our B. So this is what we have. We go to the next part, whereby you see, we're seeing that this is a general journal, So obviously we have an asset which is in form of our equipment that is going outside the business, being sold, being disposed. So we have C being the asset disposal. So we indicate it as such. We have D. D, this is now the cash payments journal, 108,000. Different from the A. It was a purchase on credit. This one is D. Go to E. Our E comes here. We have got our E here, depreciation. On November 1. Very important. Let's take note of the date. Depreciation information. We see information about November 1. We have it here. The equipment that was purchased on 1 November 2015 was sold for cash on 1 November 2016. 1 November 2016. So we check in terms of where we have the information. 1 November 2016, our year. Let's try to find out where our year is ending on 1 November 2016. Our year is ending again 1 November. So if you check here, you'd see that this is it was purchased on 1 November 2015 and sold on 1 November 2016. So it means it stayed the whole year. And depreciation on equipment is provided at 20% per annum. So if we say 20%, which is 20 over 100, then multiply by the cost that we have on 1 November, we go to the assets account. See that on 1 November, it was purchased for 1 November. We got 120,000. So we will try to see is we are having 120,000. And then obviously we multiply by 120,000, we are going to multiply it by 10%. So we come here, we just multiply by 120,000 there. 120,000. So we are told that this was purchased on 1 November 2015, and it was disposed. We can just try to see according to the information given on our non-current assets. I'll just try to. So our financial year ends, let's just take note, we made a mistake. Our financial year end is 31 May. 31 May is our financial year end. So let's take note of that. So if you come back here, you'll see that 31 May up to the day it was disposed, which is now 1 November. So we are saying 31 May, we say June, July, August, September, October. Then 1 November disposed. So we have 1, 2, 3, 4, 5. So it's 8 for 5 years. You make a proportion of 5 months. 5 over 12. So basically, that's how we are going to present it in our answer section, whereby we say 10%, which is 20 over 100. You multiply by 120,000. And then you make a proportion of 5 months. And then the answer that we are going to get is 10,000. So that's what we have on that part. And then you go to our F. This is now depreciation. Depreciation on May. Depreciation. We know that if you refer back to our asset account, we have got 500. Let's just try to see. We have 360,000 that we have, and then we have got the 112,000 was disposed. So we're going to say 360,000 minus one that was disposed, 112,000. You see what we are left with if we subtract there, so that we get it as 270,000. And then we multiply it by the percentage rate, which is 20%. Which is 20% to find the depreciation for the equipment that were there for the war year. So we can just summarize that working, which is now our F. If we are saying on our first calculation, 20% is a decimal 0.2, and then we multiply it by. So multiply it by the difference that we have for 360,000 minus 120,000. Now we do that, we get depreciation for the year, which is going to be 48,000. Then now we try to find out about depreciation for the asset that was not there for the complete year, for the whole year for 12 months. So the one that was introduced during the year, we are seeing it here. And it was on December 1. So it stayed for the whole of December, January, February, March, April, May. 1, 2, 3, 4, 5, 6. It was stayed for 6 months. So basically, I also say 20% of 180,000 times 6 over 12. So we're saying 0.2 times 180,000. And multiply by 6 over 12. And then the other that you're supposed to get is 18,000. And then from there, you can now be able to add the two so that you get the total. So we add, we see that the total that you're supposed to get is 66. 66,000. So that's what we have. Then go to the next part, which is now our F. We've got our F, the one that we've just calculated. So we go to our G. Our G, obviously, we know that it's going to the general, it's taken from the general journal or sale of asset. If it's a loss, it's supposed to be transferred to the profit and loss. and it's going to be debited in the profit and loss to represent it's a loss. When it's a loss, it's an expense, remember? So it's debited in the profit and loss. So it means G is going to be our profit and loss. So we come here, we give that description of profit and loss. We try to refer to the next part where we've got now the asset disposal account. So we take notes what should be on the debit side of the asset disposal, what should be on the credit side. So on the debit side, you put the asset value on cost. The asset that was disposed on costs comes on the debit side. So debt is going to be 2016 and November 1. That's when it was disposed, 2016, November 1. So we just refer back. We see that if we refer back again, we see that that's when it was disposed on this day, which is this day. So the cost, we see that is 120,000. So when it's taken from equipment account, it's transferred at cost, which is 120,000. So that's the figure that we are supposed to put on the debit side as equipment. And we're saying the amount that we have is 120,000. And obviously, this is going to be our general job. And then we need the accumulated depreciation, which should be on the credit side. Date is still the same, 2016, November 1. And accumulated depreciation, we general journal again. So we refer back in terms of the depreciation that we have for that non-current asset. Remember, this is the accumulated depreciation account, and you see that this is the one that is going to asset disposal, 24,000. So go to the credit side, put our 24,000 as clear as that. So we have 24,000 here. And then we are given loss on sale. Loss on sale, we already have it. Loss on sale, and it's also general journal. Remember, we are given it here. It's loss on sale of asset, and the amount is 9,500. So very simple. We transfer each 9,500. And then the figure that we don't have is the amount that it was disposed for, proceeds on the sale of the equipment. So this is going to be our bank, indicating the proceeds on sale of that equipment. So this is going to be the balancing figure. So we see that 110,000 is the one that is supposed to come in between the double lines. Then the balancing figure becomes the bank amount, 120,000 minus 9,500 minus 24,000. We get 86,500. So this becomes the asset and disposal account. Then we still have another part that we need to finish, which is saying, give one suitable reason for the equipment being sold so soon after it was purchased. So what reason can we have? Sell a non-current asset immediately after it was purchased. So obviously, it's not a suitable asset. Obviously, it's not suitable for the business. Basically, we say it was not suitable for the business. It was not suitable for the business, maybe because of the needs of the business. Maybe it's a small, it's a small equipment which has less capacity than the demands of the business. The demands needs an equipment with a higher capacity. So in that case, it can quickly be disposed. So that can be a reason. It was not suitable for the business. That can be a reason that we can also raise. Or it's not generally, it's not efficient or unproductive. Basically, those are some of the reasons that we can try to come up with. So this is the question. This is the last part that we have on question 3, and we still have our question 4, which is going to be the last question on this question paper. Moving on to our question 4, it is 21 marks. It requires you to spend 12 minutes on average. So our question is on bank reconciliation. So the question reads, the following information is being extracted from the books of village stores on 28 February 2018. And then on the third part, 4.1, use the additional information provided to calculate the final totals of the cash receipts journal and the cash payments journal for February 2018. Our question with 12 marks. So we are going to start with our journals, but also our 4.2, we've got February 2018 with 7 marks. So we are just going to add the reconciliation at the same time as we post the transactions. So we can say remember our bank reconciliation statement is a comparison of two documents, that is the journals representing the ledger, the bank account in the ledger, and then we also have the bank statement. So those two documents should have the same balance at the end of each financial period. So if the balances of those two documents are different, it means there's need for us to correct the errors by preparing the bank reconciliation statement. So bank reconciliation statement reconciles the two balances so that they become the same. Very important for us to take note. And as we also correct the errors, remember using our bank reconciliation. This is our bank statement, and we are saying this is our debit side and this is our credit side. So what we are going to do is the debit side of the bank statement should see transaction on the cash payments journal. And then the credit side should see transaction that we see on the cash receipts journal. So this is what we have. So we just make a comparison from that respect so that we can be, it becomes easier for us to prepare the bank reconciliation statement. So so what we are trying to say is transactions or entries that we see in the cash payments journal should be appearing on the debit side of the bank statement, and then entries that we see on the credit side of the bank statement should be appearing in the cash receipts journal. If there are differences, then corrections needs to be done. So going to our information given in the question, you'll see that we start with the bank reconciliation statement as at 30 January 2018. Remember, the current period that we are is for February 2018, and this one is for January 2018. So this one is the previous month's bank reconciliation statement. Take note of that, that we are given at the beginning. So whatever we are seeing there, they are outstanding entries that were the outstanding at the end of the last month. So I will go to information B. We have got provisional total for the bank column for 31 January 2018, cash receipts journal, and then cash payments journal. Then C, we have got on comparison of the above bank reconciliation statement with the February 2018 bank statement received from ABC Bank. The following was differences. The following was differences were noticed. Were differences noted? So basically, what we are trying to say is, we prepared this bank reconciliation statement at the end of the last period. So of course, we have some outstanding entries that we indicated in this previous month's bank reconciliation statement. So on this information, we are it's a check in terms of if the outstanding entries that you are having in the previous period, the bank reconciliation statement, are now appearing in the current month's bank statement. If they are not appearing or there are mistakes that needs to be corrected, then they can be corrected. So that's what we have. So let's try to see on our answer section where we're going to have our cash receipts journal column and our cash payment journal column. And then we've got the initial balances which needs to be collected pre-entered. So we can now be able to go through our information and correct. So if you come here now, I will see that the first entry is saying the outstanding deposit for 30,000 rands appeared on the February 2018 bank statement. So basically, we have got 30,000, which is this one. It was outstanding at the end of the last period. So this statement is now saying it's now appearing on the current month's bank statement. So in that case, it means there's no need to correct. It means it's now correct, it's now appearing. So it's no longer outstanding. That's correct. So we regard that as appropriate. Then we go to the next one, check number 242, dated 21 July bank statement. This check is now stale. So it is now stale, meaning it can no longer be processed. But remember, whenever a check is issued by the business, it's recorded there and there before it leaves the business. So it means this stale check is already inside our journals, under the cash payments journal. So since it's now stale, it means it has now to be removed. So how do we remove it? We remove it by entering in the cash receipts journal. So if you refer back to check number 242, you see it's 1,900. So we are saying it's already appearing in the cash payment journal. So by removing it, we put it in the cash receipts journal. So we go to other section 1,900. We don't put 1,900. We go to the next one, which is now. It means with this, we are done with this one. We're going to go to the next one. Check number 291, dated 29 December 2017, has been lost in the post. Check number 298 was issued to replace the missing check on 28th. Cancellation of check number 291 or the issuing of check number 298. The check did not appear in the bank statement. So basically, what we are saying is it was lost. So it means it was not processed in on the bank statement. So it is still outstanding. So what we can say about that check is it was a check that was lost and it was replaced. So what do we need to do? We can just try to see again according to our explanation. Check number 291, dated 29 December 28, was issued to replace the missing check on 20th February 2018. No entries were made for either the cancellation of the check. So we refer to check number 298. Check number 298, we can just try to see in terms of that check number. Check, it was replacing check number 291. So 291 is the one that we have here, 2,140. So this is the check that was lost and replaced. So as it is lost, it will remove it. Remember, initially when it's an outstanding check, it will be under the cash payments journal. So we're saying all these entries that are outstanding checks, they are under the cash payments journal. So since it was lost, we first of all remove it from our book. We got 2,140 under the cash receipts journal. 2,140 under the cash receipts journal. Then after we've removed it, we now enter the correct amount under cash payment journal with the correct description of the invoice number. So we now enter again 2,140 on the credit side. So basically that's how we are going to adjust it. Then we go to the next one. So we now see that as it was not also appearing on the bank statement. So it means it's also supposed to be adjusted in the bank reconciliation statement. So bank statement also needs to be corrected. So if you go to our other section, you see that we also have our bank reconciliation statement. So we can as well update there, whereby we got balance per bank statements that we are going to start with. We are supposed to be given information. We try to go, we see that if you go to the last point, the February 2018 bank statement on 28th February 2018 reflected a favorable balance of 40,240. So favorable means it's a credit balance. So we're going to put it on the credit. So we come here, we say credit side 40,240. So already we have identified an outstanding check, which we need to put, which is now check number to the amount of it's replacing this check to 2,140. So that's the amount. So we come here. It's an outstanding check. Now we say check number. Okay, we just say check number 298. An outstanding check come on the debit side of the bank reconciliation, 2,140. And then we can proceed with the next transaction, next adjustment, whereby we are now on next point. Check number 293 appears on the February 2018 bank statement as 4,130. The bank statement figure is correct. So bank statement is correct. So you're not going to adjust for bank reconciliation. So we can only adjust for bank reconciliation when our bank statement information is wrong. So in this case, it means what is wrong is our journals. So it's a check number, which means it is supposed to be under the cash payment journal. So 4,130 is the correct figure. So if you come here, check number 293 is this one. So we are saying 293, 1,430 is the wrong figure, and the correct figure we are saying is 4,130 is the correct figure. So we are saying 4,130 minus 1,430. That's the way we add the cash payment journal. There is a lesser figure of 1,430. So we need to find by how much is it smaller. Then we can now be able to calculate there by saying 4,130 minus 1,430. And you see that the amount that you are supposed to get the answer that you get is 2,700. So what it means is the figure that we have under cash payment journal is lesser with 2,700. So we go to the cash payment journal and we put another 2,700. So we come here, cash payment journal. We have 2,700. And we can try to go to the next one. So from there, we can now move on to the next point, which is saying check number 296 was issued to Abad Delays Builders for repairs on 26 February 2018. Pile Stores stopped the payment of this check because the work was not completed. No entry in respect of the stop payment was made. So we are saying, remember, this is the business of we can just this is the business of Pile Stores. So Pile Stores is the owner of the business who stopped the payment on this check, and it's check number 296. So we come here, we see that check number 296, we have it, say 2,900. So it's under cash payment journal. So we need to stop it by reversing it. So 2,900 has to go under cash receipts journal, and this doesn't affect our bank reconciliation statement because it's not there. So we do need to remove it since it's not already appearing on the bank statement. So we have got 2,900 under cash receipts journal. So we come here, we say 2,000. We go to the next part whereby you see we now have on comparing on the February 2018 cash journals with the February 2018 bank statement. Following differences were noted. So we go point by point. We've got a deposit of 2,100 rands received from a debtor on 28 February 2018 did not appear on the February 2018 bank statement. So obviously, this is affecting now the bank reconciliation. It's supposed to be adjusted in the bank reconciliation statement. 2,100 is outstanding deposit. So we go there. This is our bank reconciliation, and we got outstanding deposit 2,100 on the credit side. Remember, outstanding deposit goes to the credit side. Then we go to the next one. For check 285 for 3,200 rands dated 5 February 2018 was correctly reflected in the bank statement, but had been written in the case journals as 2,300. This is an error that is affecting the journals again. Bank statement is correct. So the correct amount is 3,200. So what was entered is smaller for the check, and all checks appears under cash payment journal. So you put a smaller figure under cash payment journal. So by how much now we say 3,200 minus 2,300. So we make a calculation whereby now we say 3,200 and then we subtract 2,300. And you're going to get your answer is 900. So we see we put a smaller figure by 900 other cash payment journal. So we put it other cash payment journal 900. Go to the next part whereby we are saying check 301 for 250 runs dated 28 February 2018 did not appear in the February 2018 bank statement. So this is now clear. State in the bank reconciliation statement. We have bank reconciliation statement. We've got 450 of check. So this is an outstanding check. Outstanding check 301 of 450. So we go there. Outstanding check number 301, 450. Go to the next part. We have got check 303 for 8,000 rands issued to make a suitable for rent on 25 February 2018, but dated 15 March 2018. Did not be entered in the February 2018 cash journals because the bookkeeper was uncertain what to do regarding this check. It's not even in the cash journals. It's not appearing in the cash journals, but it is supposed to appear in the cash journal. So it means it's an outstanding check. So we need to put it in the cash journals, and also it's going to affect our bank reconciliation. So we have 8,000 under cash payment journal. And we are saying it's also an outstanding check here, whereby we are saying check number 303. Check number 303, 8,000. Check number 303, 8,000. So that is what we have on that part. And then we can proceed to the next part, whereby moving on to the next part, whereby we are saying a check for 1,000 rands received from a debtor dated 5 March 2018 had not been deposited into the business bank account nor entered in the cash journals. A check of 1,000 rands are received from a debtor dated 5 March 2018 had not been deposited into the bank account nor entered in the cash journal. So this one, it has a post-dated check. It's a post-dated check being received, but since it's not appearing both in the journals and their bank statement, and it's a post-dated, which means for the current period, it's not going to be recorded. So we are just going to leave it. Then we go to the next one. The bank statement reflected a direct deposit of 200 rands received from ABC Bank, being interest on fixed deposits. This was not recorded in the cash journal. So obviously, direct deposit, it means it's supposed to be under cash receipts journal. So it's affecting cash receipts journal 200. Then we go to the next one. So from that one, we go to a check received for 890 was dishonored because of insufficient funds. No entry had been made to record this new development. So remember, as we received the check, we recorded it under cash receipts journal. So when it was dishonored, it means now we need to remove it by entering on the other cash payments journal 890. So here 890, and it doesn't affect our bank reconciliation. So we go to the last part, the February 2018 bank statement, and this is just our. So from there, we go back again to check in terms of to cross-check in terms of the outstanding checks that we have in the previous month's bank reconciliation statement, where they all addressed. Remember, we addressed the 1,900, we addressed on 2,140, and this one, and 294 for 3,200. was adjusted. Let me see. The one for 2008 was adjusted. This one, as we adjusted it under the reconciliation, and we suppose 2008 we adjusted it other cases as well. So it was attended. So we tried to check again. So we are left with check number 294 3,200. So it means this one is still outstanding because it's not mentioned again under the section of C, whereby we've got comparison of the above reconciliation statement with the February bank statement. It's not mentioned again, so it means since it's silent, it means it's still outstanding. So you need to put it in the bank reconciliation as an outstanding check to number 294. So we have check number 294. And we have an amount of 3,200. So this is what we have in terms of that part. So we cannot be able to balance our account. Our accounts will start with our journals, whereby we are saying we just add the column of our cash receipts journal. And then if we add, we see that we are going to get a total of 26,510. We add again the column of cash payment journal, we get your total is 30,590. We go to our bank reconciliation, remember we need to balance it. We compare the two totals of the two columns. We see that we're going to give a greater total on the credit side of 42,340, which is also supposed to appear on the debit side. Then we subtract all what we have on the debit side to get the balancing figure, which is supposed to be 28,550. So this becomes your final balance. So it's a credit balance of the bank statement, which is a debit balance of the bank account. So the balance that we have here, we are saying, describing it from the point of view of the bank account, it's going to be a debit balance of the bank account. So to verify if you've done the correct way, if 20,550 is the correct balance, final balance, you calculate the balance of the bank account by coming here. You check the opening balance. I mean the balance that we have in the previous month bank reconciliation. Here, if you calculate the balance here, and then you add it to your cash receipts journal, and then you subtract cash payment journal. You are supposed to get your 28,550 to say you've done it correctly. So we go to 4.3, we say what can the business do to avoid what happened to the check number 242 and 291 in the future? 242 and 291, we refer back to see what did transpired. 242 and 291. 242 did not appear on the February 2018 bank statement. The check is now still. 291, it was lost. So the issue of being lost, we are saying, obviously we can encourage the use of EFTs so that we avoid the issue of being lost. So we are saying encourage use of EFTs. And then the other one became stale. And also for it to avoid the issue of becoming stale, obviously, we can also encourage the use of EFTs. Because if we use EFTs, we can not encounter the problem of stale checks. Remember, stale checks, it means this check is out of date. So basically, that's what we have. So to avoid that, if we make the payments using EFT, we cannot encounter that problem. Then we can also raise another alternative solution, which is use of direct deposits or reminders to remind them to make early transactions so that we don't face those scenarios. So basically, those are the solutions that we have. So this is the question paper that we have, guys, of a match test, and we are seeing that this question paper get 100 marks. So basically, this is what we have, and thank you for listening. And hopefully the video was helpful. And please don't forget to subscribe and share to our channel. Let's not forget to share the link to all our colleagues who are doing grade 11 accounting. Let's meet again in the next video.